one minute we're China bears and the next minute we're China bulls. Australian Super have had a presence in China now for the last couple of years, and they've been unpacking this complexity further. Our speaker, Stephen Joske, is going to tell us about what Australian Super's done and why, and a little bit about what they've learnt so far. And it's an opportunity, I think, to think about China from a fun perspective and how to go about thinking about China. But I've also asked him to give us his views on the impact of China on the Australian economy, as our exposure to China is much more than our specific investments in China, and I think that's something that we haven't yet covered off fully, so I think that's something that we can have a bit more conversation about. Stephen is the Senior Manager Asia at Australian Super. He's based in Beijing. He's been here for 9 years. I thought it was about 9. He's been previously an economist at the Economist Intelligence Unit in Beijing and the Australian Embassy in Beijing. He's going to talk for about 20 minutes and then we'll have questions. And for the purposes of today, and I think in the spirit of industry fund collectivism, I'd like to take the liberty, Stephen, of calling you our man in Beijing. He has said that he's happy to answer any questions that you have on anything. So please take the liberty to do that. And please welcome Stephen Joske, our man in Beijing.
I suppose our view is very much, we're in complete agreement that long-term growth prospects in China are real and very good and you can't afford to miss them. And equities, of course, are our prime focus too as a global investor. And equities in China are certainly cheap. But I think for us, we take a very macro-driven approach. So from our point of view, our advice is actually stay away from Chinese assets in general for next year. And they're cheap now, but they'll probably be even cheaper in a year and maybe even longer than that. So I'll go on to explain in detail exactly why we think that. So we're sort of like short-term bears but long-term bulls. First of all, just to say, roughly how we set up in Beijing and what we're doing here first. We basically we set up a small office in the CBD here about 2.5 years ago. Logistically, that's quite a straightforward process. There are a few funny things in China, like getting a company registered takes about 6 months doing all the procedures, compared to say a week or so in Hong Kong. But it's actually a very easy process. You basically pay a small fee to a business consultant, that they do it all for you. It doesn't involve any great stress, just a bit of a wait. It's a fairly business-friendly environment. Obviously, institutional investors are quite popular people in China. Even though technically China is awash with savings and doesn't need foreign capital, they actually really do love institutional investors. Stuart mentioned the extreme volatility in the share markets driven by too many short-term day traders. And so a big institutional investor is exactly what they need to calm the markets down. So we're sort of a very popular class. And any people setting up here will be quite welcome. The only sort of difficult issue about actually setting up in China at the moment is probably the thing you can't see today, all the really heavy pollution. It's actually put a lot of people off moving here. It's actually quite hard to attract personnel to come and work for you in China at the moment from offshore, particularly if they've got children, because the pollution can be quite horrific and really unsafe to put children in particular, I think. So if you're looking at actually expanding, I guess it's harder now to get the right people here than it may have been. And we see that in the trend where people in Beijing say that they'd prefer to be in Shanghai because the air's better. People in Shanghai say they prefer to be in Hong Kong because the air's better. And people in Hong Kong say they want to be in Singapore because the air's even better. But that said, I think you really should come to Beijing just because this is where the action is. If you think China's big now, it's going to be bigger in 10 years' time. And it's already moving global markets. It's done that since about 2005 or so. Or 2005. And the things that go on here, you need to see them and be able to kick a few tyres and see what's really going on. They're very divided, diverse views about China. The bulls and bears are real. A lot of people with very divergent opinions, and you all need to make up your own mind as to what's really going on and invest on that basis. So I guess why we're actually here, as I said, it's not hard to set up. You just need to make a commitment to do it. But I suppose why we're here is just reflects our investment philosophy. The way Australian Super invests is we do our own strategic asset management in-house, and we do that on the basis of in-house macro forecasting. That's just our philosophy, and that works for us. So what we do, most of what we do in the Beijing most of the time is we do our own forecasts of all the emerging markets out of Beijing, because China in a GDP sense is the biggest single chunk of emerging markets. And even more than that, even as we heard the Chinese stock market doesn't really track Chinese GDP, it's interesting that the emerging markets share market index actually does track Chinese GDP surprisingly well. So it's something you can't afford to ignore in that sense. If you want to put your global investments in any realistic context, you need to have a very firm view on China. Now, you can pay some external consultant to get a view. Obviously, there are quite a lot around at reasonable cost. But the trick is to integrate that with your own investment process. So we find doing it in-house, having plenty of toing and froing with the rest of the investment team, so everyone's thinking along a consistent basis is the way to go. Because as I said, you've got plenty of China bears out there. So what do? Do you just stay out of China forever? Do you get back in? And when do you get back in? You need to make a decision on that, and the timing will actually be very important. So you've got to have confidence you can get that right. And often doing that in-house just gives you that extra added confidence and the ability to integrate that with your decision making. A couple of other things apart from that core role of macro forecasting centering on the Chinese economy, a couple of other things we do in Beijing. One has sort of less priority because we're not actively investing immediately, but we're essentially trying to build long-term relationships with potential investment partners. That can be a whole range of people, but obviously being on the ground here means they tend to notice you more, and they realise you're here for the long term. And that can be all sorts of people. It can be big Chinese state-owned investment companies. It can be other pension funds from around the world. There's a whole universe of Chinese financial managers of various kinds. So it's good just to know who are the good people to deal with, and just those very complex issues you've heard about, like QFI and RQFI. Obviously, you've got to make decisions about who you get to manage it, and when you acquire a quota, and do you need a quota or not, and that sort of thing. Our sort of basic approach is, we probably will get a QFI quota eventually, but obviously, if we're short-term bears, we don't want to do it today. But I think, as you saw, if you take a bottom-up stock-picking approach, manager selection is very important. And you've got to select managers who can deliver in long term, not just too reliant on some lucky breaks. And that's particularly hard in China because it's a very new market for managers. A lot of people just don't have long track records, and yet they have performed well. So you need to be able to make judgments on who to go with for the longer term. So in that sense, just being here just makes that process a bit easier. You can get a chance to talk to people over time and see what sort of operations they run. The third thing we do out of the Beijing office is just we set up an internal advisory body called the Asia Advisory Committee, chaired by Bernie Fraser, who I'm sure you all know, but he used to be on our chair our investment committee. And the idea of that is we get together a small group of basically semi-retired financial market experts based in Hong Kong and Singapore to provide us with a bit of strategic advice about how we should go about getting ready to invest in Asia when the time's right. We set that up 2 years ago, which is an interesting time in the sense the last 2 years have been truly shocking for investing in Asia. As you know, the emerging markets have underperformed compared to other equity classes. So so the emphasis is a bit on just making sure we've got the internal, our individual asset class managers have got sort of strategies in place so that when the market improves, we'll be ready to invest. So that's been quite a good internal discipline, just to making sure that we've done the work. And part of it also means, are we recruiting the right people so when the market turns around, we can move quickly. So that's an ongoing process, but I think it means we can be more confident that if things do turn faster than expected, we can get on the front foot quickly. But that's just an advisory committee which essentially meets quarterly. But because it's sort of integrated with our portfolio asset managers. They all come along and attend most of the meetings. The other part of it, I guess, is what's the best place to start? If you look at the other reason for China is so important is, back to I think your question about what's the impact on Australia, is in the past you could actually forget about China and get away with just investing in BHP and Rio. They've been really good proxies for Chinese growth, much better than the Chinese share market. So what's changed? Well, as you've heard, growth is slowing down in China. But if you recall Stuart's list of the bottom-up view of the growth opportunities in China, very little of it was actually steel intensive, quite a contrast from the past. So clearly the whole nature of future growth in China is quite different from BHP, Rio, Reliance, steel, which means you've got to basically get direct exposure to Chinese A-listed shares focusing on the consumer and service sector. So totally different investment problem, much more complex too. The other thing is sort of a feedback into the performance of your Australian investments. China has a housing cycle every couple of years. I guess what we've noticed though is that the effect on Australia is actually becoming larger. China is just sucking far more of our imports than it ever has in the past. It's mainly just iron ore, which means we're actually more vulnerable to a downturn in China than China itself is. I mean, the Chinese economy is much more than just real estate. I mean, it is a very big key sector. But I suppose what I'm suggesting is, we know from recent history in China that China can have a normal cyclical downturn in real estate, but GDP definitely doesn't collapse. They don't have a recession. Whereas now Australia is faced with what could be a minor downturn in Chinese GDP can have a very big impact on Australia through that iron ore connection. You can get a sharp correction in iron ore prices, hits the resources sector, hits national income through the profits from the mining sector. But there are a lot of sort of accelerator mechanisms. You can get a concurrent hit with Chinese tourism, Chinese people coming to Australia for education, and that increasing flow of Chinese investment into real estate. All those can be hit at the same time if there's a slightly bigger than normal slowdown in China. So it doesn't mean China's falling apart, but you can really see a potential big impact on Australia. And to some extent, it's new territory. The counterexample is what happened in the Asian crisis, 1997-8, when very severe recession in Asia, but we didn't have one in Australia, even though it was our major trading partner. And that was primarily because we benefit from this really flexible exchange rate, which means we could get a really quick adjustment in the Australian economy. Whereas the Asian countries love to experiment with pegged exchange rates, and it really came back to hit them then, and they just couldn't adjust quickly enough. Australia's still got a very flexible exchange rate, which is great. That will help us adjust, but we're just far more exposed to China than we've ever been in the past, and that's something that's dramatically increased in the past 5 years. But there's no relationship to the late 1990s at all. So we are in new territory, and the risks are a bit higher, so we'll just have to pay a bit more close attention to the next Chinese real estate downturn, which has already started. They're currently in the middle of a downward cycle, which has got a bit way further to go. Probably better talk about, why exactly we are bearish on China in the short term. And I think this gets back a bit to why it's really a really good idea to be on the ground here trying to understand China, because it is a really strange economy. Things don't operate the way they would overseas. And monetary policy is a classic case. Monetary policy is why China's going to have a bit of an unpleasant time over the next year and probably a bit longer. Now, back in Australia, in fact, in most developed countries, what you have is, the Reserve Bank governor gets out and does his monthly statement or gives his regular speeches, and he signals very clearly what he thinks is happening to the economy and what the Reserve Bank thinks is good or bad and how they're planning on responding. And in China, it's absolutely the complete opposite. Because they're very worried about sentiment, they're worried about a herd mentality, they're worried about scaring people, they'll actually send signals which are quite opposite to what they're really going to do. And that's what they're doing at the moment. The current talk you'd be picking up from the press is China's doing a minor stimulus. It's not a massive one like 2009 or even 2012, but they are sort of doing a bit of stimulus, including monetary stimulus. And yet if we look at the data, they really need to tighten up in a hurry or they will be in a real problem. It actually dates back to 2012. In some ways it dates back to 2009. They had a massive, this massive stimulus, which had a big impact on, which really supported GDP. They ran up a lot of debt, but they very quickly, by 2011, they'd completely neutralised that increase in corporate credit. So you could say it was a successful stimulus, and since they stabilised the economy, they ran up a lot of debt, but they'd stabilised that. So it wasn't sort of an ongoing threat to growth or the financial system. Then something went wrong in 2012. As we know, China's slowing. They had these growth targets of 7.5%. They saw that slipping, so they started stimulating again. But then things really went wrong because, first of all, the stimulus didn't work. Growth still kept slowing. And they've never managed to fully neutralise that increase in credit. So they've got a classic credit problem, which is a precursor to a recession in any country. If you just let credit run for years, you're going to have a problem, some sort of correction. And they're in the middle of that now. They probably misjudged on a couple of fronts. One is they just misjudged the extent the economy was slowing. To some extent, you need to just accommodate that rather than try and throw money at it. And I think they're only realising that now. But you can see that they've been having that internal debate. But anyway, it does mean, basically, by the end of this year, they're really going to have to start real tightening of credit in China. It won't induce a recession, but it'll induce a further housing downturn worse than the one we've got now. So you'll notice it on iron ore prices. And if they don't do it, let's say they really get scared about growth and just keep pumping things up, then that's just a bigger reason not to invest in China. The basic environment is, the sooner they get this credit binge under control, the more investable it becomes. And they can control it. They've done it a number of times in the past. They just need to bite the bullet and get the process out of the way. So what we want to see is, stable total credit to GDP for almost a year before we really think it's time to dip back in and start investing in China. And that applies to basically all asset classes, shares, property, you name it. So valuations are good, but they're probably going to get a bit worse as that credit tightening process rolls out. And we're not sure of the timing, but there was a lot of talk that it would start in March after the National People's Congress meetings, the sort of big annual political event. Once you get out of the way, you can start the painful policies. But it didn't start. And I think our thinking now is that there's been basically 2 years of stagnant growth in world trade, no fault of China's, but that stagnant growth of world trade has meant China's economy has been sort of struggling to keep its growth targets. We're expecting a bit of a minor growth in world trade this year because Europe and the US are starting to show positive signs, so that boost they get to exports should give them room to do that overdue monetary tightening, which if they do it and get it out of the way, then it's investable. Oops, running out of time, but I'm going to have to deal with the most exciting issue, slightly over time, but ask some questions on it. And that is the corruption issue. And it's actually integrally tied to the time of investment, because they said a lot of it dates back to 2012 when they did a big failed stimulus. And actually, part of the good thing about that is a fair bit of the money was actually stolen by corrupt officials or parked in strange areas rather than invested. So if you actually withdraw some of that monetary stimulus, you're not actually cancelling real projects, which is good means you can do it without really screwing down the economy. And the other big issue about the whole corruption campaign is, what does it say about political stability? But actually, our basic message is China is actually very politically stable. You know, they had a military coup, I guess, in 1976, but since then, for a developing country, it's been very, very stable, and they've got a political succession places in place which do work very well. But obviously, if there's any new political environment, there's a slight increase in that political instability, which is real, but I think it's not a game changer for investment. But what we're seeing, you heard in the presentation from Lucy Hornsby yesterday that there's been a massive anti-corruption campaign. It surprised everyone by just how far it's going on, but it's actually even bigger than that. They're really pushing the boundaries. Just the announcement last week where they're going after some of the key energy sector, you know, the coal mining vested interests. I mean, it's all politics, not really economics. Sorry, it's politics, not corruption, but very tied to economics. That's completely rewriting the rules of Chinese politics as they've been in place more or less for 30 years. I mean, these people aren't meant to be touchable, but Xi Jinping is going for them, and he's in so deep, he's going for broke, the signals, which means he wants to completely decimate the opposition's power structures. And so there's potential instability. I mean, someone might try and push back against him. So there's some risks there, but I'm sure he's aware of that. And but it's basically good for investors, because if he gets true control over the vested interests that have been effectively resisting state enterprise reform, he can get in there and kickstart market-oriented reforms in the state-owned sector and boost long-term growth. So if it works, it's good for the long term, and it should make a lot of those SOEs much more investable than they have been in the past.